Good morning, good afternoon, good evening, depending where you are on the planet, and welcome to the Monday, the 20th of June, the Juneteenth holiday webinar here, the Bull versus Bear webinar for Trade Day. Steve Miley on the call. Given it is the Juneteenth holiday in here, which kind of caught us a little bit by surprise. I was looking at the end of last week on Friday and through this week's calendar and saw that it's now, I was aware of the Juneteenth holiday. I wasn't aware that it was going to be a markets holiday, but it is a markets holiday. So that's the first thing to note, okay? Today, guys, we go here to first of all, probably most importantly, the New York Stock Exchange calendar. Here we have it's Juneteenth, National Independence Day. It's a holiday, okay? Juneteenth holiday observed. So stock market's closed, okay? So no underlying cash market. Same as far as I'm aware for the bond market. Obviously, foreign exchange markets are open. If we go to the CME calendar in here, it's not gonna. It's gonna. Well, if I open this up, it's gonna pop out. So, and I'm not gonna be able to share it with you. I don't think. Because I think it pops it out. Yeah, it's just a download in here. But oh no, it's gonna allow. It does pop it out. Oh no, it doesn't. Oh no, it just downloads it, right? Yeah, it's just downloaded it down here, and you're not going to be able to share it. Yeah, you're not going to be able to see it. I don't think because it doesn't open up in the browser. It opens it up as a an Excel sheet in a separate tab, so you're not going to be able to see that, guys. But what I can tell you is, for most products in here today, trading is halted on Monday at 12 o'clock Central Time. Midday. Some of them are open longer, but equities certainly 12 o'clock midday. Interest rate products 12 o'clock midday in here, and reopen at 5 p.m. 1700 hours Central Time. And that's what I'm looking at if you download that DME site, right? So yeah, I will stress to you guys in here. It's something you need to be aware of. It's something you can still see. Oh gosh, what's happened there? Okay. Something you guys need to be aware of that it's going to be illiquid today, right? It's going to be illiquid. Markets could jump around, they could gap around. There's no underlying cash market. My strong sentiment, it's a holiday. Take it as a holiday. Don't trade, right? I know there's people in there on the evaluation challenge today trading. I know that people can't leave it alone and they want to trade, which is fair enough. But then do be, aware that markets could get illiquid, particularly going into this afternoon, particularly going into, and they will close at midday. Sorry, and won't reopen until 5, and then they're probably going to be very illiquid at 5 o'clock. Because come 5 o'clock Central Time, there's gonna be nothing open, right? No European markets, no Asian markets. There's been no cash market in the US, so just be really wary of that, guys. It's something to really keep in mind. Let's take a look at the calendar. Obviously, nothing in here from the US, given that the Bullard is speaking later today, but nothing really. And we've had some data out of Europe. It's fairly light data. Nothing to really. Some ECB speakers. Lagarde speaking. Lagarde, I see Lagarde speak so many times. Lagarde rarely shifts markets. Okay. The other thing I want to say, given it is the Juneteenth holiday, I'm going to keep this webinar fairly brief in here. You guys should be trading anyway, in my opinion. If you want to go and trade, fair enough. But there's not a huge amount to say. What I will do is focus on the week ahead, which is what I tend to do on the Monday anyway, and do the recap for the week. So this is downloadable. I put this up every weekend. It usually goes up on the Sunday. In here, kind of it's a look back to what's the major macro fundamental geopolitical events of the week. Then we take a look at what the market developments were for the week, and take a look at what's coming up for the week ahead. So that's uploaded. You can find that in research section on the trading room on the Trade Day website in the members area when you're on the evaluation challenge. If you're on the 14-day free trial. So it's all about central banks last week. Let's do a little recap on last week's. I know you guys are all going to be over the Fed, right? Because a lot of our users are in the US, or if you're not in the US, for the rest of our users in Europe and in Asia, you're trading US products. Yes, the Fed was interesting last week, right? But they hiked what we were anticipating, 0.75%. The market had priced that in very quickly from the prior week after the US CPI data. We also got the Bank of England hike rates as well by 25 in here, 0.25%. Again, as anticipated, they did signal that more was needed. It was their fifth successive rate hike. Remember, the UK The Bank of England started hiking rates before the Fed from the end of last year. 5 successive rate hikes now of 25 from, and so actually started off, I think they started off with 0.15, it's either 0.1 or 0.15. And then there have been 0.25s since then, since December. So, but those were kind of all built in and anticipated. What wasn't anticipated and what was built, and then the Bank of Japan was stayed very dovish on Friday, which was a real disappointment. I thought they might shift slightly more hawkish. They didn't. The two standouts last week were these, though. So we had the ECB, having had their meeting the week before where they indicated a shift to a more hawkish tone, indicated an end to their quantitative easing program and also signaled a rate hike for July. What's happened, and I spoke about this a lot last week, and I'm going to give you a really brief recap, but basically European government bond prices collapsed in price, meaning their yields went significantly higher, okay? And that move in here, which we've been seeing in the US anyway, because the US have been, indicating higher interest rates. So we've been seeing similar moves with treasury bonds, but there was a more aggressive move lower in European government bonds in price. So a move higher in yields. But more importantly, there was a blowout in the spreads across the European government bond markets. So what that means is there was a widening of the spreads between what we call the core, and when we talk about the core of Europe, it's really France and Germany, to the periphery, which is kind of everything else. And the big periphery states like Spain and Italy, particularly Italian government bonds, if Italian government bonds blow out too far in here, it can cause a stress, okay? And they did that. So the German government bonds, the Italian government bond spread blew out wider. At the same time, German government bonds was shooting to higher yields anyway. So the Italian government bonds was shooting even more aggressively to higher yields. And that's a real concern, okay? So there was an ad hoc emergency meeting of the ECB on Wednesday last week. They haven't given us concrete what they're going to do, but basically they're going to come in and make sure there's not a disorderly moving market. So effectively what they're going to do is come in and support the peripheral bonds. They're going to be back, even though they said they're going to ease the quantitative easing, they're going to stop the quantitative easing program. They're going to parry that back. They are going to continue to come in and buy probably European government bonds and probably at the periphery. Okay, so to keep those government bonds from going too quickly to higher yield territory. The other shock was last week, the SNB, that's the Swiss National Bank. The Swiss National Bank have not increased interest rates even, for 15 years. And they currently had interest rates which were negative at negative 0.75%, and they moved them to negative 0.25%. So they're still negative, but they hiked rates by 0.5%, okay? And that was completely unexpected, a hawkish pivot, and said they would do more tightening if needed. And that took the market by shock. So this is even one of the most dovish central banks pivoted, the SNB pivoted to more hawkish, and the ECB came in and had to shore up, but they actually you would argue they stepped back to more dovish, but, they're having to come in and act in the market to stop stresses in the market. Okay, so these were the major developments. They were probably more major developments last week than the Bank of England and the Fed rate hikes that were already priced into the market. And what we saw last week was US stock averages plunged lower. The S&P ended up down from its record high from early 2022, down 24%. It went below that 20% level, which signals it's a bear market. And also it was the worst weekly fall for the S&P since March 2020, as the pandemic was starting to really break globally, particularly into Europe. And we saw the real global breakout of the pandemic in March 2020 when stocks went into free fall. It was the biggest down week for the S&P since then. And European and Asian equity indices starting to look more vulnerable, having been slightly more resilient, particularly European indices looking more vulnerable. Now, there is something I think of interest in here, and I go down, I've got the charts down here, and if you can see the charts here, I'm going to just make this a little bigger. There is a real kind of divergence in here across markets. And what I want to do is focus on that for a little bit and talk about that. So clearly equity markets are looking vulnerable. Look, there's the S&P, the last 2 weeks, two big. These are weekly charts, remember. This is a weekly candlestick, okay? So 2 big down weeks. There's a bear gap in there as well. The market gapped lower on Monday. Okay, now with this, it's down 20%, it's down more than 20%. Bear market is 20%, it was down 24%. Okay, broke down below the May lows. all looking very, very negative. And here's the DAX. Now, the DAX is the German index. Again, two big negative candlesticks, a gap as well. It took out the May low. It isn't as low as it was back here early this year in March. However, looking very negative. And been more resilient up here with this rebound is looking more negative in here, okay, now. So the DAX playing catch up. So equity markets very much in what we call risk off. Traders, investors, less likely to take risk, taking risk off the table. Okay, we're in a risk off environment. That's what the equity markets are telling us. Now let's take a look at what the US 10-year yield is telling us. Yes, we shot up. So risk off will take yields higher. Okay, going to higher yields. We go into risk off scenario. Okay, higher interest rates. Okay, driving us to in that risk off scenario, and that's as we would expect it. And that's been happening for the last 3 weeks. 1, 2, 3 weeks higher, and equity markets going lower. However, last week from Wednesday, the US 10-year yield went back lower after the Fed went back lower. And you got this pattern in here. It's a shooting star candlestick on a weekly chart. That's really a big statement. It's what a bullish, well, it's actually a bearish failure in here, because going up in here is, remember, going up in yield, which is going down in price. So this is effectively a bearish failure in here. But it's so bonds were selling off and rebounded aggressively. And we'll take a look at it. We're going to look at the bond futures chart shortly, the 10-year futures chart, okay, the 10-year note futures chart. And this is a rejection, right? So this is now telling us risk is now down to lower yields, okay? And similarly, because the dollar moves in similar to price pattern, sometimes with a high correlation to the 10-year yield, we saw a shoot up in the dollar, but then the dollar came back lower as of Wednesday after the US hiked rates. We saw a move back down lower. So this again, dollar going up because of risk initially, okay, going up because we're in risk off. The dollar is a safe haven. Dollar going up. Dollar is the preferred currency to be held, and particularly over the yen at the moment, because the Bank of Japan are doing nothing. They're staying uber dovish. So no one wants to own yen. Dollar yen has been going higher as well. So we've been seeing dollar rally as a safe haven as we're in risk off. However, last week, I say turnaround. Again, this candlestick in here is like a shooting star candlestick in here. It's a failure candlestick. It's a negative candlestick pointing the dollar back lower. Okay, and that's telling us we're in risk on mode. Okay, so this chart, the US dollar index chart, plus the US yield chart, which are kind of highly correlated, okay, positively correlated, they're telling us that they're trying to signal maybe the risk is now back to lower yields and lower dollar, okay, which is a sign of risk on, okay, risk on, where equities are telling us risk off. So something's broken in here, okay. This seems to be not right, and now, and does it tell us that equity markets are nearing maybe getting to a conclusion of this sell-off, okay, with that turnaround in the bond markets, okay, and the turnaround in the dollar, in the FX markets as well. So it's going to be something really interesting to watch going forward, okay. Let's take a look at what we've do have going forward. So it's a fairly light week after the busyness of last week. I'm going to zoom out on this a little bit. So going into this week now, we're noticing the war in Ukraine. Monday, the 20th of June is Juneteenth. We already discussed that. Cash markets closed, partial days for the futures markets, half days for the future markets. Central banks, okay, we had the PBOC this morning, nothing of real interest there. The Reserve Bank of Australia and Bank of Japan meeting minutes on Tuesday and Wednesday, respectively. That's not going to tell us probably too much. We're not that interested. We get Fed Chairman Powell testifying to Congress on Wednesday and Thursday. That testimony is already out. This is his biannual, twice a year testimony to Congress. Okay, so it's the biannual report from the Fed to Congress. Okay. And that report has already been published. However, the Q&A for that is going to be interesting. So whether we get something else from Chairman Powell on Wednesday and Thursday, those are kind of the standard events of the week. Going into the week as well, we've got UK inflation data Wednesday. Now, remember, the UK economy, the Bank of England were hiking rates before the Fed. The UK inflation rate is higher than you're seeing in the US. You could argue the UK is kind of leading the global economy into this kind of inflationary. It's not that it's leading as in it's the cause of, but leading as in the data from the UK seems to be ahead of a lot of the global data. So this UK inflation data, I think, is going to be really interesting to see if we are getting any kind of slowdown. We're not expecting any kind of slowdown, but let's see where it comes in with respect to what the forecasts are. So that's certainly going to be interesting on Wednesday. Probably the biggest data of the week we're going to get is the global S&P flash PMI data. Purchasing Managers Index, they are always important. Good lead indicator data. We get that to come through on Thursday. We're certainly going to be watching for that on Thursday. Right, let me go. I'm going to just go through quickly in here some of the headlines, but I mean, really very little given the Juneteenth holiday. I mean, talking about Biden and China and Taiwan, obviously that's a concern. It's not going to probably matter. This has been bubbling away for months, if in anything, for years. That's probably not going to impact markets right here, right now. Crypto plunged over the weekend, plunged and rebound. Dropped basically 15% Bitcoin, I think, on Saturday, and rebound almost the same on Sunday. But it did take out that 20,000 level in here, Bitcoin, and an important breakdown. But then it did hold at a support level, a long-term support level, and rebounded, and as the other cryptocurrencies did in here. So potentially going to have an impact. Contagion fears in here. Let's talk about a mega liner that's being scrapped. Okay, not great, but I mean, not really a focus for us. And it's a cautious start to the week, but obviously with markets closed in here. So, yeah, nothing really to kind of zero in on. European stocks gain with US futures. So US futures are open. They have rebounded slightly this morning, European stocks. And the dollar down. So this is telling us, this is kind of dollar going down. European stocks, US stock futures rebounding in here in early trade. And then an article on Bitcoin. Bitcoin broke below 20, rebounded back above 20, but struggling to hold back above that 20 level. And again, crypto industry fears contagion. Okay. And then more on crypto in here. There's another article I wanted to show you here. Where is it? From Reuters. No, can't see it. But basically, where we are at the moment, go take a look at where the European markets are. Going into today, so you can see the European markets are up. Not huge, but nevertheless up. So we've got, the CAC in here, pretty much unchanged, little change on the day. We do have some news from France, political news. Looks like Macron's not going to get a government together, so that's a bit of a worry why the CAC's not particularly up. The DAX, the German index, up about 0.4. The FTSE 100, the UK index, up in here about 1%. And if we go and take a look at where we are in the futures market in the US, so obviously here, in here this morning, okay? But remember, we're only open till midday Central Time today. Let me take a look now at what else did I want to show you? Oh yeah, just to show now we're nailing on in here the CME tool, nailing on a 75 basis point hike at the next meeting. Okay, another 75, another 75. And if we go into September now, then the kind of mix between either a 75 and only a 50. This one here signaling a total in here of 125. So this is saying 75 plus 50, only 50 in September, but this is saying another 75 in September in here. So 60% chance of probably only a 50 basis point hike at the meeting after. Let's have a quick look. I just want to show you that, as I said I would, on the Treasury market. Let's go take a look at that on the prices, on the price chart. I'm not going to do loads of analysis. I'm not going to encourage you guys to trade on the equities today. But you're here. So here we see, look, there's the sell-off at the beginning of last week. And that's from the Fed, okay, post-Fed, okay, boom, boom, back higher. Wednesday, Thursday, Friday, so back higher. And if I flip it, there's no weekly chart here, but then this is a kind of a rejection, yeah. So we got a solid rebound in here, and we're not seeing that on the equity market. So there is a divergence there between what equity markets are telling us. A quick nod to those equity markets, though, but you can see inside pattern, is effectively an inside pattern at the lower end of the range in here. Back on Friday, and then still inside pattern in here today. You hold a gun to my head. I'm slightly bullish going into today. I really am not going to do loads of analysis in here, guys. It look good. Nasdaq in here, negative back on Thursday, edged up on Friday, edging a little higher today. So tentatively bullish. I would strongly suggest not trading in here going into today, though, guys. Okay. So I'm going to wrap it up there. Take it easy out there. Enjoy the holiday if you're in the US. I'm going to be back with another Bull versus Bear webinar tomorrow. Until then, have a good one. Cheers.